Hi everyone, welcome to the LCG's weekly webinar. We are going to talk about this week's major macroeconomic events that could shake up the markets. But before doing that, let's first start by the risk warning. So please be reminded that the information and comments here are under no circumstances to be considered an offer or solicitation to invest, and nothing here should be construed as an investment advice. Please also be reminded that the information provided is believed to be accurate at the date the information is produced, and losses can exceed deposits. So before we start talking about this week's events, we will just have a quick look at what happened last week. So we closed last week on Friday by a heavy sell-off in the US dollar after the soft US inflation triggered the expectations that the Fed may not be in a position to raise interest rates for an additional time before the end of this year, and that caused a heavy sell-off in the US dollar. As a result of the sell-off, we have seen two major pairs. Breaking out important technical levels. One of them has been the Aussie dollar, and the other one has been the GBPUSD. As you can see on this chart, the Aussie dollar just rallied above the 1 year high levels here at 0.7780 levels, and we are now at 0.7880 levels, and the way is well open for a further rise towards 0.80 level against the US dollar. So there are two factors which are supportive of this positive trend. The first one is the fact that the US yields are softening due to fading expectations of another rate hike this year, and the second factor is the good data that we've been receiving out of China since the beginning of the year. So we can see that this positive trend has not only a technical but also fundamental support in order to develop further. But when we look at technical indicators here, although the trend and momentum indicators are strengthening in the positive territory, we can see that the relative strength index here is now at the overbought territories, which could actually cause a short-term downside correction in the Aussie dollar. Traders remain buyers at dips, and the price pullbacks could be opportunities to buy the dips. So the technical levels, which could be interesting for opening professional positions for traders who are interested to take advantage of the Aussie dollar rally, are seen here at 0.7755 level, which is the 23.60% retracement on the latest April-July rally, and 0.7673% here, the major 38.2% retracement down to this level. The trend, the Aussie dollar is going to be considered in the positive trend. Now let's look at the GBPUSD. So GBPUSD broke a very important resistance, which was standing at 130.45 level. So if I zoom out, we can see that this level corresponds to the 38.2% retracement on the post-Brexit sell-off here that started to June 23rd, all the way down to October 7th. So we have seen a decent resistance this year at 130.45 level here in May, and finally, the weakness, the sell-off in the US dollar, sent cable above this resistance all the way up to 131 levels. So now we can see a downside correction due to we are not overbought, but we are highly bought conditions. So the trend and momentum indicators are positive, but it's going to be a make or break week for the GBPUSD, because the UK's inflation data is going to be determinant on whether this positive trend could develop further, or is it time for the GBPUSD to correct on the downside and come back below the 130 level. So the UK's inflation is going to be very important, as said. So the May inflation has been 2.9%, and June inflation is also expected to be 2.9%. So we're at a very critical level for the inflation, because above the 3% level, the Bank of Governor Carney is asked to write an open letter to the Chancellor in order to explain why there has been such a deviation from the bank's 2% inflation target. So basically, the Bank of England Governor Mark Carney defends his position, saying that the Brexit situation, the Brexit reality, is supportive or is a good reason for keeping the rates low in the UK in order to provide some monetary support through the Brexit procedures. But of course, we have seen that the MPC members are slowly being anxious about the rising inflation in the UK. We remind that 3 members out of 8 voted to raise interest rates at last month's meeting. So there are some tensions at the heart of the Bank of England, and an inflation rate above the 3% will certainly revive the Bank of England hawks and keep the GBP US dollar above the 130 level, and we can extend that rally to new technical levels. So let's see what are these technical levels. So now we are back on our daily chart in cable. So if I zoom out, so this is the post-Brexit sell-off. The next important level stands at 134.20 level here. So the extension of this rally, if it's supported by stronger inflation, could reach the 134.20 level. And it's going to be the 50% retracement. So the cable would have retraced 50% of losses that have been recorded posterior to the UK's Brexit referendum. Another important event of the week is going to be the European Central Bank meeting. The European Central Bank is expected to keep the rates unchanged at today's meeting, and no one expects the European Central Bank to modify its rates until 2019. The main question is going to be, what is the ECB going to do with its quantitative easing program? So currently, ECB is buying 60 billion euros worth of sovereign bonds per month, and this program is about to end in September, and the markets are expecting what is going to be the ECB's next move. So we know that ECB is unlikely to abruptly stop buying bonds. So we expect that we think that in the dirt of a clear guidance, a reasonable next move from the ECB could be a tapering in the amount of the monthly purchases, but for a flexible duration in the program. So over the last 2 meetings, investors have been disappointed because of the lack of details regarding the ECB's QE exit program. At this week's meeting, we expect that at least there is going to be some insightful guidance. In the absence of guidance, we could actually see a downside squeeze in the euro-dollar, which actually have recently broken above its 115 level. So let's now take a look on the euro-dollar daily chart. We have this morning broke about 115 level, and it caused a rally on stocks. So euro-dollar advanced 115.36 level prior to the European Central Bank meeting. So the upside potential is there because the trending momentum indicators are actually very positive and very strong. We are about to reach the overbought conditions, and there are uncertainties about the European Central Bank meeting. So even though the market is pricing in an insightful comment from the European Central Bank, which could actually cause a further rally in the euro-dollar, the risk of downside should keep the investors from going full blast into long positions. The upside in the euro-dollar chart is expected to be somewhat here. 116.16 level looks like a reasonable positive target for the euro bulls before the European Central Bank meeting. So this level corresponds to the 2016 peak. On the other hand, a downside squeeze could easily bring us back to 113.07 level and 111.66. Finally, Finally, the Bank of Japan is going to be on the watch this week. So the Bank of Japan is not expected to come out with any surprise at this week's meeting. It has made its position very clear. So we have very strong dovish expectations out of the BoJ meeting. So last week we have seen a significant rally in Eurozone sovereign yields. If we take a look to the Eurozone's 10-year government bond yields, so we have seen a very sharp rally here, and that also caused a rally in the Japanese stocks. As a result of the rally in the Eurozone sovereign bonds, the Bank of Japan decided to accelerate its 3 to 5 year maturated bond purchases in order to fight back the yield rally and keep the yen at reasonably low levels against the majors. But the Bank of Japan has been unsuccessful to stop the sell-off in the US dollar against the yen. So now we have seen the USD JPY having a bearish reversal here. The USD JPY just stepped under the 112.32 level, which was a 38.2% retracement on the June-July rally. So the bearish consolidation zone could encourage a further sell-off towards the 111.65, which stands for the 50% retracement, and the 50-day moving average here, which is in blue, and further down to 111.40 level, which stands for the 100-day moving average. So we would like to remind that the BoJ meeting could eventually revive the BoJ dose and halt the slowdown or the sell-off in the USD JPY. We remind that the divergence between the Fed and the BoJ is still supportive of a higher USD JPY. As soon as the sell-off in the US dollar loses momentum, traders will be seeking deep buying opportunities for a reversal towards the 115 level, which have not been broken during the course of last week due to soft US data and a dovish semi-annual testimony from Janet Yellen. So now that we talked about the four majors here, the euro dollar, GBP US dollar, USD JPY, and Aussie dollar, we're just going to have a quick look at gold. So the gold is taking advantage of softer US yields. We are now about 200-day moving average, which stands at $12.30 level, and which should provide support for a further rise about the 38.2% retracement here, which stands at $12.40 level. Above this level, we are expecting a further recovery towards the 50-100-day moving averages, which stands at $12.47, and a further extension towards the $12.50 level, which stands for the 50% retracement. Again, we remind that the hedge funds have trimmed their net long positions over the course of last week due to the global rally in the sovereign yields. However, the fact that US sovereign yields are stagnating and have slipped below the 230%, so this is 10-year yields slipping below 230%, is actually encouraging further inflows into the gold market. The upside could be limited, but the upside potential is not exhausted yet. Finally, we are going to look at the WTI crude. We remind that there is a significant selling pressure on oil prices due to the fact that the OPEC has been unsuccessful reducing the global supply glut by reducing its production. And we have also seen that the US shale production is at all-time levels, and the Gulf of Mexico is becoming more competitive in the market. The Iraq, Nigeria, and Libya are producing more oil, and they are tolerated to produce to extract more oil in order to finance their fight against ISIS. So there is a very complicated geopolitical situation, and the OPEC is actually not successful reducing the global supply in order to push these oil prices sustainably higher. Sustainable higher would be above $50 level per barrel, and ideally $55 to $60 level per barrel. Last week we have heard that the Mid East oil may become a little bit expensive due to the local restrictions, and that actually gives way for the world's biggest refiners to deviate their demand towards Gulf of Mexico or the U.S. oil, and that could be actually a problem in the future for the OPEC agreement if the Mid East oil becomes too expensive to the extent of causing the Mid East countries losing demand. Then there will be less probability for a significant or an impactful agreement from the OPEC countries in the future. So this is where we stand this week. We have seen resistance at 47.50 level last week. We expect the resistance to be stronger by the 48 to $50 levels here. As said before, traders remain seller on tops in order to take advantage of the downside squeezes. This is all for this week. You can follow us on social media. You can also subscribe to our daily newsletter in order to keep in touch with the markets and have the breaking news and our view on daily basis. Good luck trading.